Hi, Vivek.
Hello, hello. How
Hi,
are you,
this is
Maritza?
Maritza. I've been joining the last few weekends. It's amazing. I love your production. I have a question for you. I'm
Sure.
new to options and I did a 7 day, well, kind of sort of new. I did a 7 day data expiration on the E-minis,
Mm-hmm.
and I've it's my first time doing them on the E-minis, and supposedly it expires on April 1st. Do you know, just curious, if they expire in the morning or the end of the day on those 7 day DTE ones? Do you know?
Does it say AM in front of it? If it
It
is
does not.
AM,
No. So that means end of day on Monday, probably.
That's right.
yeah.
Okay. And then the other interesting thing is, I don't know if you guys noticed, but if you look at the E-minis, um, the if you look at the E-minis, the symbol, at least on Thinkorswim, for example, let me find it. Do you see?
That is
Oh,
slash
okay.
ES.
It it's fixed. Yeah, the slash E is it's fixed. Yesterday it was showing at 51.94 or something, and I didn't understand what had happened, but now it's all fixed.
Yeah, yeah.
It's showing
Yes.
the bid and the sell and the price and everything's all aligned.
Yeah.
And
So
see how it's showing negative 28.50 on the ES? But what does that mean? Because it doesn't, is it because it's so on Friday when the market was closed, the numbers came out about inflation and it was higher than expected. So is
so
that
this so because futures even trade at the timings when the stocks don't, and I don't do futures,
yeah.
so I may not know exactly what I'm saying.
Okay.
Someone else can help me, but I guess this may be, even though the stock market was closed, maybe futures was open, and this might be reflecting the last trade. Anyone else,
So
please pitch in. I don't
this
do
time,
futures.
this time, usually it's like you say, Vivek, but this time futures closed at 2 p.m. Pacific on Thursday, and there's been no more activity ever since Thursday 2 p.m.
Okay.
So whatever we see is just probably a bug because of the market being closed.
Okay. Yeah, because it's showing negative 28.50, but yet it's still at what it closed on Thursday. So
Yeah,
interesting.
yeah. So
It'll be interesting to see what
until
happens.
Sunday at 3 p.m. Pacific,
Yep.
that's when it's gonna move because of that PCE
Right, right,
and
right.
Powell.
Okay.
So I'm curious, Maritza, you're saying that it's the first time you're doing options. What made you jump into directly doing E-mini SMA? And that too futures, and options on futures, not even on stock.
I know. Futures, I've traded a lot. I've traded
Okay.
a lot of futures.
Okay.
But on options, I'm just now getting into doing options on just on the on the SPX, for example, on the Russell.
Yeah.
But at the time, the market was closed and the only thing open was the ES. So I said, "Oh, let me try this strategy. It's a 7 day DT strategy." I said,
Mhm.
"Let me try this strategy on the ESs." And I'm the futures I've been trading those probably, I don't know, 9 years. So
Yeah. So you understand the product well. I mean, that's
yeah.
my only concern was.
No, yeah, I understand the product
Cool.
really, really well because that's
Cool.
the only thing I've done for the last 9 years. And I'm just now starting. So I'm kind of doing it the opposite. Most people start with like, the indexes and then they go to futures. I'm
Exactly.
yeah, I did the other way. So I'm super, super familiar with the futures and how they work and how they operate, but I've never seen a this whole Good Friday thing. I just it caught me for a loop because I wasn't sure. It's showing negative 28.50, but yet it's the actual candle isn't. So it was just weird. It's so I think like somebody just mentioned, it'll all resolve itself on Sunday, obviously. But I was just curious when the actual options, because it's my first time doing an options on futures. I just would trade the futures outright.
Yeah.
So it's my first time doing the options on the futures, and I just didn't know how the expirations worked, but I'll find out on Monday, I guess.
When is your expiry, Maritza?
April 1st.
Okay,
But the
so
weird thing
yeah,
is, like on Thursday, it said I'd made 100% of my profit. And it usually will not do that until it's actually fully expired and settled, you know? It was weird.
well, they look at the mark price, which is not
Okay.
always correct. So if the bid
Okay.
and ask do wonky things and they get
Mm,
wide, then the mark can be off, and
Okay.
then it will say, plus or minus P&L. But yeah, like you said, it's not going to be. Do you want to take it to expiry, or do you want to close it?
No, I'm fine taking it to expiry. I've got 100 points on either side, so
Okay.
unless something crazy,
What
100, not
what's
even.
nice is I
Mhm.
think the settlement and the buying power goes back really fast
Oh
on
yeah,
futures.
okay, good. Cool.
You
Thank
know,
you.
the point that I would like to make is that the market is it based upon the bid and ask. So if there is no bids and sometimes the mark price, which the brokerage is trying to figure out what is their risk, they can change it significantly. So
Yeah,
the good idea is not to base any information that you find after the market close. Don't
okay.
use that to make any decisions because Monday morning it will be entirely different.
Yeah.
So that's what I would suggest. Don't look at the market over the weekend altogether if you can avoid it.
Right, yeah. I mean,
And
because I've done futures forever, I always look at them on when they open on Sunday, but when it's closed, you can't do anything about it anyway. So I was just curious to see what's gonna when they expire. So I'll let you guys know next weekend what time it happens.
it is not necessarily just the future. It is it based upon the market also, the stock and option pricing. There's so much of a wide variation after the market close and where there is no significant bid and ask spread.
Mhm.
And this is one reason, Sri, I think you and I talked about earlier, and you asked me question why I don't do futures is, yeah, I've been on the stock on other side for years, but I haven't yet started on futures is, because the futures trade for much longer and I don't want to get myself sucked into, trading and looking at my screen for much of my time. So yeah, I don't want to focus and look at my screen over the weekend and trying to, manage the trades, etc.
The other
I know
point I want to
that's a
make is
foolish reason, but that's another one
Mhm.
which I said, stock forces me
It's a good reason.
to
It's a
get
good
away
reason. There's
from the
been many a
screen.
night where I've been up at 1 a.m.
Yeah, I don't want.
Yeah.
The
Yeah,
reason why the
it's a good
reason why I
reason.
get in focus on the stock market is to get control on my calendar, and then I don't want the market to start controlling my calendar where I have to get up here early in the morning and say, oh gosh, what happened to my futures?
anyway.
Yep.
Apart from that, your account value might also fluctuate over the weekend. So don't be just ignore that. And Monday morning or whenever the market opens, you will see the correct information at that time.
Cool. All right. So good discussion. Anyone else have any questions before we jump into today's session? What else you guys did yesterday? Like I said, earlier I was saying I went for a hike with one of my friend yesterday. It was a good, 3 hours spent well. Anyone else did anything new?
I checked out Computer History Museum in
Oh,
Mountain
nice.
View with my kids, and it was nice.
Yeah. Yeah, I think, yeah, it's been a few years, once we went there. But it's a good place. Were you able to, yeah, I think they still, I remember when I went there, they had an Atari. Do they still have that Atari game
Yeah.
console? Okay.
Yeah, they still have it. My kids loved Pac-Man. Like they spend 1 hour playing Pac-Man there.
Yeah, that's one. All right. So what I want to talk about today, yeah, I spent, we also had, we didn't have, the market was closed yesterday, and I also spent some time this week catching up on some of my book that I was reading. I'll talk about that, and also read a couple of shareholder letters. And there's so much of a wisdom in these letters from one of the good investment houses. Even if you don't own the stocks or the shares, I think it's good to go and read through what some of the big or best investment managers have to say, what they see happening in the world, right? So I want to go through a couple of them. Larry Fink and Pershing Square, Bill Ackman. And today is the first time we are meeting after the end of May. Technically, I mean, it's still not end of March. Technically, still not the end of March, but from a stock perspective, it's the end of March, right? So I'll share, as always, I share my portfolio after the end of month. I'll give a quick rundown on what I hold, top 15 positions in my portfolio, and I'll invite Q&A. If you have any questions, feel free to ask. And yeah, other stuff, what I've seen this week in the market, the craziness continues in the market, and that's where it's time to be cautious. We'll go through some of them, any other Q&A, etc. So that's pretty much today. I have planned, but I'm always open to something else that you may want to talk about. This session is for you guys, right? So feel free to pitch in with your questions or any other topic that you may want to bring up for discussion. I just want to make sure that the next 2 hours are fruitful, and if you think that something that we've been talking about is not useful for you and you may want to bring up something else, feel free. Okay. All right. Let's start with today's session. So yeah, I just want to give you a quick update on what I've been reading. So I just finished these 2 books. The one on the left side you see is Take on the Wall Street by Arthur Levitt. And Arthur Levitt is an ex-chairman of SEC. And I really find it as a good book because it talks about some of the games that are being played by corporates, even related to accounting shenanigans or how they structure their products. What's happening in the mutual fund industry. So the edition that I read was a bit old, so some of them have been taken care by the SEC, but still it was a good read to understand us as an individual investor, what we should watch out for if I'm reading about any company, right? So it was a refreshing take on the Wall Street. The other one which I really liked is A Chip War. And I talked about this book maybe a year ago, but I never could get to reading this book. Anyone else have read this book? Where is our friend SK? He is from this industry. Yeah, yeah, he says it's finished it. Exactly. So this Chip War is an amazing book and basically gives you complete rundown of the semiconductor industry, right from the origins of Texas Instrument, before Intel, you can say the ancestors of Intel, Shockley, from Shockley Semiconductors to Fairchild, and then over to Intel, and right up to where the state is today, what's the overall value chain, what are the players in this value chain, and how it is becoming strategically important, right? So if you are the craziness that you are seeing today in the market around all the AI related stock plus the chip related stocks, right? Look at Nvidia. Nvidia is a chip designer. They don't really make a chips, but they're a fabless, right? So look at Nvidia, look at ASML, TSMCs, so this is a great book if you really want to understand this industry and which are the key players in that industry, and that helps you to make a decision around the various stocks that you may or may not want to hold in your portfolio, right? So, and this also got me thinking, is little unrelated, but kind of, which piqued my thought, was every big industry has gone or has grown from the need coming from the defense side, right? Let's talk about the industrial, the big steel mills and the big industries in US. They all grew rapidly during the World War I when the wars were won based on how many tanks you can build, how great is your shipbuilding capacity, So basically, whatever it was won on the base of the strength of a steel, right? Then came down to internet era, wherein the internet found its origins from projects sponsored by DARPA. Right? And that's where the first need of trying to communicate or the connect various industry sectors started. And from there came internet. And even from the chips, etc., again, the need came from the defense side, wherein again the part, and that's mentioned in the book. If you have the book, if you can get your hands on it, go ahead and read it, in terms of how the Pentagon wanted and they sponsored, basically funded some of these companies like TI, because they wanted to create a mechanism for the way to make the missiles more intelligent, or more highly precision missiles. And now I'm thinking, from now it moved over to the microelectronics. The next war may be fought based on the software side, right? And we will not know another for next 10 years which are those projects that Pentagon may be funding, right? And I'm sure, I mean, we have been moving the goalpost on which are those industries which will define or enable a country to regain or to maintain its supremacy in the world, from steel to microelectronics, and now probably to the software side, right? And that software could include a cyber warfare or AI or whatever. So keep an eye on this. Some of these things generally start, some of the best technology in this country have all can find their origins in the halls of Pentagons. So that's, I started thinking about what are the next technical trends that are coming out in which defense is investing, because many of these generally start as a government and then they move to the commercial side. Right? So question to you all, any other book that you're aware of which helps you to understand a complete industry? Anyone else can share from your reading any other book which helps me, to know the end-to-end of how that industry works? What are the players? What are the value chains? What are the advantages, or the drawbacks of a within an industry? If not, maybe I'll find something else. I'll go and check on Twitter. Someone might have figured out any other, because I find this really interesting. It helps you to understand the complete industry. All right, let's continue, move on. A few more charts.
Excuse me. There was a book I read like 30 years ago. It said that before there's a stock market crash, first is the computer boom, and then the last thing before a stock market crash is a biotech pharma boom. Any legitimacy? I don't know, it was a long time ago.
So I've not looked at in terms of before the crashes what things have gone up, but generally, I mean, I could see that there is some iota of truth in that, because if you are crashing means the market has become euphoric. When the market has become euphoric, it means all the industries that are like on the longer tail of the risk curve, I mean, that are more risky, would probably go up because there's a lot of free money floating in it. And biotech is one sector where there's a high risk, high reward sector, right? So, and I don't know if there is a correlation in that, but I wouldn't be surprised that if we suddenly start to see a lot of these unprofitable biotech companies which are only involved in research, don't really have a product, and are and are valued at extremely high valuation, that may be one way to look at, it probably we are at the euphoric part of our investor sentiment cycle. Sachin says, how to listen when markets speak, risk, myth, and investment opportunities in a radically reshaped economy. Thank you, Sachin. Jim Cramer suggested 2 days back. Maybe I should take my thanks back. Yeah, inverse Jim Cramer. No, I'm just kidding. Looks like, yeah, I'll probably look for this book. But right now, the one which I'm currently reading is a history of Salesforce. I don't remember the name of the book. It's something in the cloud. I think it's probably there in my bag. If you're interested, I can take that up. But that talks about how Mark Benioff he started Salesforce. So I just finished the part 1 of it. And next, I'll see what I'll get into my reading agenda. Anyway, so let's get back to the markets. What I'm seeing on the valuation side, a few charts. You make your own decision. Valuations are elevated. If you look at a Schiller PE, and I think last week also we looked at, and it still has gone even higher. Now it's trading at 35.14. If you look at the .com, that's where it was close to 40. So relatively, it is expensive, right? And this we're looking at only at S&P 500, so that comes with all the caveats around S&P 500, which is driven by market cap weighted. If Nvidia and some of these companies continue to go higher, it is little bit convoluted by the cap weightage. Looking at the normal PE ratio, not the Schiller PE, but the normal PE ratio still 28. Even that is higher. I mean, not over the, let's say, last a few years, but over a longer term, S&P trades at what, anywhere between 13 to 16 PE. Or maybe, let's say, after the internet or more tech companies becoming a bigger part of S&P, let's elevate it to maybe between 15 to 19. So 28 is still on higher side. So from that perspective, it does look that the valuations are higher, right? But if we dig a little deeper, and yeah, this is price to sales ratio, which is again 2.85 is still overall S&P is higher. But if you look at little deeper into S&P and look at, for a moment, compare the normal S&P, which is market cap weighted, versus your equal weighted S&P, then the valuations on equal weighted S&P doesn't look that extreme, right? So equal weighted S&P is close to what? 18, less than 18. That's pretty normal. So that means, except a few big ones that are driving the market and pushing up the valuations of S&P over to 28, the rest of the market, the majority of the other companies aren't that expensive. The trick is, how do you even find which other companies to look at? But the fact that the S&P is just at 28 doesn't mean all the companies are trading at an expensive valuation. Right? So if you want to look at and invest into equal weighted S&P, there is an ETF for that also. Right? There is a RSP ETF, which is basically equal weighted S&P. So they, irrespective of the market cap of a particular company, they're just gonna invest same amount equally in all the companies of S&P, right? That's what equal weighted is. So it doesn't matter if you're Nvidia or if you're Microsoft, you'll get the same treatment. Another chart on valuation, P to E multiple. Even if you look at this P to E multiple, majority of price to earning multiple, forward price to earning multiple of S&P 500, the bigger portions fall between 10, 15 to 15 to 20. So there are a very few companies which are trading at the long tail of the of the PE, which is like some of them are greater than 55. Right? There are a few between 45 to 50, but some of these companies may be the ones which are larger market cap, which is driving the valuation of the overall S&P to higher than where the majority of the other companies are. So looking at this, doesn't look like that the overall market is expensive, even though S&P looks to be trading at much richer valuation. Right? Let me read some comments. Read, write, own. This is Chris Dixon. Yeah, I heard about this, but I've read I don't know. I've read many other I would say articles and the books on the blockchain over past few years. So I wasn't really keen on this one, but the first book is more commodities. The second one is more blockchain focused. I mean, we've been talking about this whole Web3 is wherein you actually own the stuff, right? It's not just Web 1 was reading what's there. Web 2 was you start to post your content, and Web 3 is now you are the ownership. You own your own digital identity. You own your own content. So Chris has probably done a good job in putting it together in a book. Yeah, I haven't read a book on related to crypto economy for some time now. Maybe I'll put this on my reading list. So then DJT overpriced. We'll talk about DJT. I think I have a chart around DJT, the newest meme stock on Reddit. No, Reddit itself is a meme stock. Forget about the meme stock on Reddit. So Reddit itself has become little meme stock. All right. Question, will we repeat 1994 and have a soft landing? That's a question on the mind of all the investors. Fed is talking about, we are gonna decrease the interest rate. Don't know when. Market is predicting we're gonna do it in maybe June or something. But the question is, will we achieve the soft landing or not? Market in any case has priced in soft landing. That's why we see where the market is today, right? S&P is what 10 point some percent for the year. I mean, we are just 3 months into this year and 10% already up. What else? What more can you ask for? Because we already priced in that the economy is not going into recession. And the Fed has already come and talked about, in the recent update after FOMC, that they will decrease the interest rate. You're not going to get 7 cuts. That's okay. You're going to get 3 cuts. Now, the question is not that you're going to get a cut. The question is, it's not if, it's a question of when. And I think market is perfectly okay with it, even if you get it in May or June timeframe. Obviously, we didn't get it in March, which was during the January timeframe. We were expecting it in March. That didn't happen in March. Fine, we'll get it in June. The fact that it's almost a certainty that we're gonna get a rate cut is driving, the markets where it is. Anyway, so we're looking at, are we gonna get a soft landing? In 1994, 95, we were exactly in a similar situation wherein the interest rates jumped from 3% all the way to 6% over a period of a year. Now in 2021, last 2-3 years, our base rate was not 3%, but it was 0%, close to 0. But kind of a similar pace, increase in the interest rates. And then Fed start to cut down the interest rates, and this is what the S&P has done during 1994, 1995 cycle. We priced in that it's going to be a soft landing. We're not going to crush the economy. We're not going to, engineer a recession, and everything will be okay. So not much fear in the market right now. And that is showing in the whole DJTs and the Reddit. And I think I was looking at another company that went IPO, Astera Labs. I haven't yet looked into the the details of it, because that's only 1/4 of their information is available. So there's nothing much to draw from their business, but that stock is up like 70%. And now if you put a name AI in your stock, or even if you tweet anything around Bitcoin, the company goes up like few 100%. So no fear in the market. And the way what at least I've learned in the market is the thing to fear in the market is the lack of fear. When there is nothing that could go wrong, and that's a time that as an investor, we need to be fearful in the market. A quick look at the fear index, VIX, right? It's still trading only at 13, which is, we got an election coming up, so there's uncertainty around that. And given all the things that have gone up and down in over the last, I would say, few months, the VIX hasn't moved. So I was reading about it, and something that caught my eye, I saw I think not in Bloomberg, but Wall Street has also done analysis on it. And now there are a couple of podcasts that talked about it, with saying, hey, is the VIX being manipulated? VIX, which is generally called as a fear index, investors look at a VIX to figure out how much of uncertainty is in the market. 13 VIX is kind of one of the lowest since, I would say, 2020. It's like lowest in last 4 years. And as an options, folks, and we love the higher VIX, right? You get some juicy premiums. So, but I've been in the market when the VIX was even in single digits. So that's fine. I'm not complaining that the VIX is low, but all I'm thinking is, given where the economy is and given some of the uncertainties that we have had in the market, why the VIX is trading so low? So there's another thought which is coming around the lot of these income generated ETFs, and we talked about a few of them on our sessions. The biggest one is JEPI, JEPI, which will give you a dividend, so-called dividend yield of almost 10%. And that is the biggest one. And I heard that the JEPI has got almost $30 billion asset under management. And JEPI is not the only one. We got similarly on the NASDAQ side. Does anyone remember? I know in one of the sessions, we went through all of these income generated ETFs. There's a JEPI, there's a similar to JEPI, there's on the NASDAQ. Essentially, all these ETFs, what they do is they sell a covered call to generate income and then pass over that income as a dividend to the holders of JEPI, etc. Now, because they are selling covered calls, and now because there are so many of these instruments and they are gathered, huge amount of asset under management, that is driving the volatility, basically driving the VIX low, because there's a lot of option selling happening. I don't know how much truth in this, but that's what read a couple of articles saying the inadvertent impact of these income, ETFs, like JEPI and I think JQLT, and there are many issuers have some of these in ETFs, is then the side effect or the inadvertent effect is that it's driving down the VIX low. On the other hand, I don't see that the call options have been are being priced low. So I don't know what's truth. Anyone have any thoughts around this? Because it's not the first time. I also heard earlier someone talking about VIX is being manipulated, because how can you say the VIX is still trading at 13 when there are so many things happening in the market? Anyone have a thoughts to share?
Yeah, it's not only ETFs, it's also hedge funds and institutions selling volatility like 0DTE. There's a lot of volatility selling happening, even outside of these ETFs, which the retailers see. which I think is making premiums too low that do not correspond to the actual risk of
Yeah, Jay,
movement.
but
Like, for example,
Mhm.
Thursday, I was looking at the expected move on Monday, and it was like 26 points, right, for the SPX, with the news coming out on Friday when the market was closed. Well, just the previous day, we moved 37 points in the last half hour of the day. So something is off, like premiums are too low. So I did something new. I bought premium for Monday's SPX. I
yeah,
did an upside down butterfly because I said, okay, this premium is too low. I'm doing an upside down butterfly at the money. So I said it's gonna move. It's gonna move some. You know, it doesn't have to move much to make me money, but
yeah.
yeah,
You,
yeah.
you got suckered into buying an option, huh?
Well, I did a butterfly, so
Yeah.
I bought two and sold two, and all it has to do is move 5 points up or down, and I'll make money. It's with Monday's expiration. I just said this is way too low. I'm not selling premium and getting bulldozed on a move.
Yeah. No, so
Why,
yeah,
But
I
yeah,
why
want
that-
besides the ETFs, I think there's hedge funds and others who are just in the selling phase because all the news has been the past year, you know, selling premium is the thing and zero
but
DTE.
isn't that, I mean, I see, on Twitter now I'm seeing a lot of retail investors are coming and talking about, oh, let's sell option premium. I mean, I've been doing it for 8 years. So for me, it's nothing new. But now I see, is it reaching a euphoria level wherein people who've been like buying, many influencers or fin Twitters who've been buying options and now suddenly turned over to the other side and saying, hey, we should be selling options. I'm like,
Yeah,
yeah,
yeah, I agree. I agree.
yeah. So I'm like, is this a like,
The
and I don't know
pendulum
how many
is
of,
swinging too far. The pendulum is
yeah.
swinging too far that way. Yeah.
Exactly. And I've been in this for many years to see, you get these gurus of the particular season. You'll find some folks coming and making a killing in one season, and then the market turns around and you don't see them again. So I
Hmm.
don't know. Maybe next time we'll have some new other fin twitters talking about some other strategy.
It's
In
an
any case, I mean,
excellent strategy. If I might interrupt for just a second, I do that very same thing. I'll buy that fly, or I'll set it up as I'll buy an iron condor rather than sell it, but make the two strikes identical, so it looks just like a fly. But I like to use it as a hedge as well against some other um, strategies that I use, because, like the gentleman just said, if you set it up one strike wide, it only has to move a very short period of time. And if you do it zero DTA, you can get the theta decay to get out of there 2 hours before the market closes with a nice little hedge.
sure. Shri, go ahead, please. You have your hand raised.
yeah. I agree that the VIX is being manipulated, and I am taking long positions in VIX, VIX, and also the VIX futures too. And I'm taking a longer time period rather than a shorter time period, and I'm willing to wait for an extended length of time. And especially with the amount of price movement that we have seen in the last 3 to 6 months, I am betting that the market is going to be down and I'll be able to make some profit at that time.
So additional thing to add is I always had a VIX call spreads in my portfolio as a position hedge, like what you're trying to do it. It's only in, I think, after a January, I didn't do it because none of them had worked out. And I was thinking about the same thing when it hit. Generally, I'll do it if it is below 15. But I realized, gosh, it is a 13. When I was preparing for the content, I'm like, I don't have any VIX call spreads. Now it is like near 13. Maybe I should go back and add VIX call spreads. So how far expiration do you go, Free? I generally go out 3 months to add a VIX call spread as a hedging for me.
Maybe I can give you some information over here. I purchased the VIX December 24, the deep in the money call, the 10 call, and I paid something about $7 or $8. That means all that I need to see is the VIX cross above 18 for me to make money. And in the shorter time, I can start selling the calls in the shorter time period. And then I can, I'm making the market in the direction that I want it to go. That's one thing. The other thing is if you take a look at the VX future, the VX future is trading at 1440 and 1436, the small one and the big one. And the VIX VIX itself is trading at 13.01. So that again tells me the VIX is going to increase in the price by the end of the expiration of the VIX future, which is going to be in the next 18 days.
Okay. Yeah, I now looked at futures. For me, because I don't spend too much time on this, for me, I only used to buy VIX and that to call spread just as a hedging.
Now, the VIX and the VIX future at the end of the time period, the VIX
Will
future
match.
time period, they have to settle at the almost the same price. So which one is right, which one is wrong, we don't know. Only time will tell. But if I'm taking a position in the VIX for the longer time period and paying, let's say $8 for the 10 call, so that is to be $18 is the amount that I need to see that move. And you can see the VIX, you can sell something in the shorter time period, or you don't need to do anything, just sit tight. And the amount that you lose is the $8 that
$8.
you $8 that you paid. It's not a significant amount for my whole portfolio to be managed in that way.
Yeah, perfectly. Yeah, so I mean, I moved over, and not just moved over. As I spoke, have shared earlier, I basically have a lot of short calls on SPY or XSP and QQQ for my negative deltas. But I should go back and maybe add, because now the VIX is a 13. And remember in 2017, end of 2017, or maybe I think early 2018, we had that Volmageddon, wherein the VIX spiked up. Now, because there is not much fear being seen in the market, I don't know. Maybe we'll see a Volmageddon or not. So if we do, yeah, then these VIX call spreads or the calls should pay off really nicely.
And the other point that I have is that VIX recently had spiked up to 17.81 in the last 1.5 to 3 months or some time period. So if it crosses the 17.81, the VIX is going to run up significantly. That's my understanding, and that's the way that I'm playing around.
Yeah, I'm looking at here what almost
Just cut it down to 3 months, and then
Let's-
you'll see the high.
let's see, 3-year, 1 day.
3 months, 3 months. So you're looking for the low?
No, I'm just looking at yeah, so where we had 2021s around last October. Yeah, now we're here. Yeah, you're right. We had a spike almost to 18 over here in Feb.
Yeah, if it crosses that one, the market is going to be tumbling, and 17.81 is not too far away. And it can happen in 1 day, or it can happen in 1 week or a month.
Anyway, so good thoughts on VIX. Yeah, I'm seeing a lot of chatter around around the manipulation. And Chandra says we are seeing uncertainty from last year with a recession on the way, but no signs in VIX. Nowadays, I think the recession, market is not even pricing in anything around recession. We're gonna have a soft landing. So this is what scares me when market like always assume that we're gonna have, it's only rosy days are ahead, and there is nothing that can derail this. Because every time we get hit in the market, we figured out, oh, there's something new which we never thought of. So that's why I'm still cautious. We're gonna go through that fear and greed index, and is still in like greed, and I'm still cautious. That doesn't mean I'm gonna get out of market. Just that, hey, we just don't want to go crazy and just keep some deltas in control. Anyway, sector performance wise, like S&P up 10.16%, nothing more that you can ask for. Surprisingly, real estate, and I know this is like probably because of the commercial real estate, that's the only sector which is down year to date, a negative 1.36. So if you've been in the market just with SPY, we didn't have to buy crazy Meta or Nvidia, or you didn't have to, time like TJTs and all that. Just pure play S&P, which is what every retail investor should do, unless you are really interested in reading through the quarterly filings of a company or you enjoy doing that. All we should do is just buy S&P 500, or if you're more interested in the tech side, buy QQQ or any ETFs. Would have done pretty nice, right? Just 10% in 3 months, not bad at all. Looking to fear and greed index, we are still in the greed phase. So that makes me a little cautious. And we have been in this phase for almost now, since I would say maybe mid of Jan. And I don't know how long will this continue, but over a longer period, as I have seen that, it doesn't stay in greed or extreme greed for much longer. But I've been waiting for some correction for almost 3 months now. It hasn't happened. Not that I'm complaining, but there is too much of a complacency, and the markets have been holding up. So yeah, we'll see how long it'll continue to hold up.
Hey, Vivek, on the like a sector performance thing, right?
Mm-hmm.
We always think that one SPY, just buy that and you can sit on it. But thing is, every time when we try to want to do that, it's already high. Is it something when you think we should really add something like maybe you should add some slowly, you can start from here, or whenever I think it's already gone, it's a 10% up, 20% up, or whatever the thing.
Yeah,
You
so
lose some time.
we would have said the same thing when the S&P was like 480. I'm still holding my short calls at 480, right? Because I think it was too high. Now the S&P is what, 520. So here's as a retail investor, right? I'm not talking about professionals who have a time to look at the markets, every day, who do this for a living. But for us who don't want to be either, because I've been doing it along with my job for many years because I didn't have a time to look at the markets, right? We gotta do our regular job. If we continue to do our dollar cost averaging into S&P over years, that's the best. So we shouldn't be even have to make a decision. Hey, is it like 522 much? I'm not going to bring in additional capital, beyond the regular dollar cost averaging. But in no way I'm going to stop doing the bi-weekly or weekly investment just because now the S&P is at 520. Over long term, that has worked out to be the best for our retail investors. Every time we will think, oh, the market is high.
But if you have the money, like money is set aside, and now if you want to add,
So
what is the strategy if you want to do that? Because now I don't have job, for example.
Mhm.
I'm not working as an employment, so I'm on the market. So I have the money. But thing is, it's something we can add slowly a bit here, or what is the
So
strategy?
here's Madhu, because I also helped another of my friend. He was going through the similar dilemma, saying, what should I do now? Like, obviously, taking care of your pre-investing checklist, make sure other stuff is taken care of, personal finance side, you don't have any other loans and all that stuff. You don't need the money for the next 3 years. All those going through the checklist. Now you've come up with a pile of money that you still have available. Again, not a financial advice because I'm not an advisor, but what I would do is, I want to invest. I have this pile of money which I not need it for next 2-3 years, and I want to invest now. I'm gonna divide it into, let's say, for next 1 year, I'm gonna do it. That means every 2 weeks, I need to invest this amount. I'm gonna do it. Pick a day and say, come Friday or Thursday or every week, I'm gonna invest this particular amount. Right? So let's say if you got a $20,000, let me make it easy math because otherwise that hard math will hurt my brain. Let's say you have $50,000 and you want to invest it over 1 year. Let's say 50 weeks, per week is $1,000, right? And then pick up a day and say every week I'm gonna do this and forget about it, right? Now what I don't want to do is suddenly think, oh, the market is going higher. I'm gonna put like 25K today because I don't know, tomorrow market could go down. Right? I don't want to time the market. But so that's what I would do if I were in the, and that's what I'm doing, right? I share that I decided not to go back to job for now because I want to do this a full time. And yeah, I'm putting money to work every week. So that's the essential part of a dollar cost averaging. And I think as a retail investor, we don't have to get too cute in trying to time the market. No one has been able to time the market except a few folks on the Twitter or on YouTube.
Yeah, makes sense, Vivek. It's okay. Very great advice. Thank you.
Hey,
Basic question, how is the greed index calculated? So there are 7 factors, Prabhu, that goes into the calculation of fear and greed index. It does include, let me just open this up, right? So it does include your put options, what are buying, where the stock is, how much. Long back I had gone through the details of it, but here we go. Look at the market momentum, what the momentum suggests. Look at the stock price strength, the breadth, put and call options, market volatility, safe haven demand with the demand of the bonds, junk bond demand, high risk bond demand. So these are the 7 factors that get into the calculation of the fear and greed index. So I consider this as a pretty I would say well-rounded factor. Prior to looking at this, the other things I find folks looking at it's, look at your put and call options. But I find this better representation because it consider many other factors also. So if you really want to look at, I'll just share this URL. That's where I picked the data from.
And how do you use this for decisions?
Okay. The way I use this for decisions is I'm not gonna go, let's say if now the market's hit new all-time high, right? And I have short call positions as my hedging, and I'm like, should I just take it off? Because I'm losing money on my hedging, even though the portfolio is going high, but I'm like, no, right now I should not. Right now still there is a greed in the market. And when there's a greed in the market, you got to be a little cautious, right? So I'm not going to increase the deltas of my portfolio right now because, gosh, the rest of the market seems to be euphoric. So that's where I decide to, take a decision on my own portfolio is, should I, lever up? Should I add more at this point of a time or not? I would want to bring in, and in 2022 is where we brought in, extra money to put for work because this whole index was in fear. And when the index is in fear or when the market is fearful, that's the time when as an investor, we can take an opportunity and go and pick the great companies because those great companies are selling much cheaper than they are actually worth.
Got it. Has the market ever been in extreme greed?
Yes, it has been. I don't know in which, probably it's been a couple of years. So in one of the sessions, and maybe I'll have to go and search, what I did was to plot this fear and greed timeline with S&P timeline, right? And there was a correlation that we could actually see that once it is on a greed or extreme greed, after that S&P will actually, go down because you can't stay in the elevated state of greed or extreme greed for longer. So yes, it has happened.
Got it. Cool. Thank you.
All right, looking at another stats, even though we think the market is all-time high, I mean, there was a question from Prabhu saying, hey, it looks to be all-time high. There are $6 trillion still in the money market funds. And we're not the only one. A lot of retail investors, or I don't like $2.4 trillion of retail investing money is sitting on the sidelines, waiting for the next crash to happen so that we can buy. I think it's a Peter Lynch that has told, right? A lot more money has been lost. I guess in quotes, I'll put opportunity cost. A lot more money has been lost in waiting for the crash than in the market crash itself. Now, overall, $6 trillion is still sitting in the money market funds because, oh, guys, looks like market is super expensive. I'm going to sit out and wait for market to correct so that I can time it perfectly and, then get in the market. No one has been able to time the market. So if let's say market have some correction, probably it will have, we don't know what the factor will be. Maybe some of this $6 trillion will then move into the market. And we may not get, again, this is just my thinking, we may not get a deep correction because there's a money that has sat outside the market for so long, waiting for a correction, that they may be willing to go back in and buy it when they actually see a correction, which will again push the market up. And that may be reason why, the VIX has been trading at 13. The dip in the markets is being bought over. So that is why we have no idea. No one has a crystal ball to know where the market's gonna go. And that is why I'm like, do your dollar cost averaging and just stay in and make sure that your portfolio is structuring in a way that you don't need that money for next 3 years. And then if you don't need it for next 3 years, how do you care whether the market goes down 5% tomorrow or not? If it goes down 5% tomorrow, you buy more of S&P. And if it goes higher, you buy less of S&P. It's the age-old wisdom of, you're buying at a cheaper price and not buying too much when it is expensive. Let's give the Fed rate watch because there's nothing much on the rate side. Balance sheet is coming down, which is great. But I think in this FOMC, Fed Jerome Powell told that they're going to reduce the quantitative tightening. So probably they may want to stabilize at 6 or 7 trillion. I think it's still higher. Prior to COVID, we were about $2 trillion. So still, even if we stabilize at 7, we have printed what, $5 trillion before the COVID, it was $4 trillion, not 2. So we're printing almost double, if not a double, what, 70% additional free money into the market. That's where the value of the dollars continue to go down. Right. Quick update on the crypto side of the house. The halving is what, 20 days out. You don't know what's gonna happen. Currently trading at 70K. Nothing much to look in here. No big moves happened over the last week. No upgrades, nothing. I think that the biggest upgrade happened was on Ethereum, which we talked about was a Denkan upgrade. After that, at least I'm not seeing anything on the Bitcoin side or Ethereum side. So just chugging along. Yeah, one big news. If you have been, watching the crypto market, is at least end of one chapter. Sam Bankman eventually was convicted. I mean, he was convicted, but it was a sentencing time for him. I don't know, was it Thursday or Friday? Got 25 years. I thought he should have gotten more. But anyway, I'm not a lawyer or not any legal scholar. Whatever judge thought was appropriate, he handed over. So 25 years in jail. Let's see how much does he actually serve. And there was an interesting chart I came across of white collar crimes and the sentencing. So Bernie Madoff obviously got 150 years. That was what, $69 billion Ponzi scheme. Sam Bankman-Fried, compared to Bernie Madoff, was better. He did only what, $40 billion was the FTX exchange, but I think the money that was siphoned from a customer was around 8 or I don't know, maybe 11 or 12 billion dollars, whatever. So that's 25 years, 25 years. Let's see. For now, we can all put this chapter behind us. I know there's a lot of negativity that was brought in by this whole fraud by Sam Bankman-Fried, and now we can we can move over to a better things now. Prabhu asks once again, what's all included in money market? So money market will be your money market funds, right? You can go and buy money market funds from your bank. Let's go back to the chart, right? So these are generally the money market funds, which in turn generally invest in the US Treasury bonds. Just talks about the government, tax exempt money market funds. So those are the details. But these are the funds which generally, I mean, even as a retail investor, if I don't need the money, like right now, we should be putting in a money market fund. I mean, you can get 5% in money market fund. Why keep it in the bank savings account, which will give you 0.01%? That's what the Bank of America will give, right? If you're lucky enough, you have a high yield savings account, you'll get 0.02%.
Do you use indexes like VMXX? I forget. It's like a Vanguard money market index. Is that so? All of that money eventually goes and get invested in. Yeah, where are they eventually going?
So the money market, because the money market funds are very safe, they're gonna go and buy I guess majority of them buy a US Treasuries.
Okay.
Yeah. Some may buy equivalent because they have to buy risk-free. Because they can't, so they're not going to put money in the market. They're not going to, even the name says money market, they're not going to put money in the market, not in the stocks. So either they'll be sitting in the US Treasuries or equivalently very safe bonds, right? But not in volatile or like stock, etc. And that's the reason why they're able to give you 4 or 5%. And because right now the Treasuries is giving you more than 5%, right? So yeah, there are the money market funds. I'm not invested in it because I hold treasuries directly through Treasury Direct. So I'm not invested in money market fund. I use another one which I think is a T-bill ETF, which is ICSH. I shared earlier. There are many of such instruments that you can use, but 4-5%. If you're not, if your cash is not making 4%, then do the right thing. Move the money out of your bank account and get the money market fund or get a T-bill. You can buy it from a brokerage firm. And the worst is keeping the money in the bank. And obviously, you have to keep the money that you need for, let's say, next 1 or 2 months to pay your bills. But beyond that, I mean, it's a risk-free 4%. Why leave the money on the table?
Definitely. And this is always used as an index to calculate how people are waiting out of the market. Is it higher the?
Oh, no. So here's the right. Like what I said just now is if you don't have a money that you want to put in use, keep it in the money market fund. So that essentially means I'm waiting for an opportunities to put the money to work, and hence I'm holding it in money market fund. So that means this is the money that is waiting for deployment. I mean, why would I? And today the money market fund, it's a $6 trillion money market fund because it is giving 4%. And if I'm a pension fund manager and my liability of pension fund is I need to generate 7% to meet my pension liabilities over longer term. Now, earlier, there was from the money market funds, I couldn't have gotten the return which I'm getting right now, right? So I'll go over to the little more risky so that I can generate more return. Go to the stock market, go to your VCs and all that stuff. Now, if I can get 5% here, I only have a shortfall for 2%. So I'll probably hold the money in this one. So yeah, so there are many dynamics, but the idea is that from a retail perspective, retail investors would like to park the money that they don't need it now and waiting for opportunities in the money market fund.
Okay.
So that's how I interpret this.
Got it. Thanks, Vivek.
Mhm. All right, Chandra. Sam is very young and bright guy. One huge mistake cost him a lot. Yeah, I mean, the greed. I have another one. Okay, and this is not just the Sam. Maybe we'll go over there, directly jump over there, and then we can come back here. And I was so shocked. One of the, let me see if anyone of you can guess this. Founder of Sun Microsystems, founder of, or maybe chairman of another company. And yeah, there we go. Wrote first check for Google. This guy has $19 billion worth, right? He got charged by SEC for making illegal profits of $415,000. Well, why you have to do this? You're like, not only, it's like, I just couldn't wrap my head around this. You just threw your reputation. You're a former chairman of Arista Networks, wrote first check to Google, and then made illegal profit of $400,000 trying to do basically because he's at this person is at very high places. One of the companies, there was some acquisition that was being planned for, and he traded based on that insider information. And he traded on a relative's account, and SEC caught with and charged him. Now he's settled with SEC. But guys, you're already $19 billion. What does it like 400K even mean for you? But I guess that's what greed does. And
I think it is also like this, Vivek, because like this guy might be doing this one as a practice. This one is a one cart. How many times he might have done like a small way.
Yeah, who
This one
knows?
is one he got caught.
Yes. So when
And
greed, both greed and fear make people do strange things. Like multi-billionaire getting caught for $400,000. His name is Andy. So his full name is really very big because I think he's German, but A-N-D-Y. So I actually searched for his name, and because I relate, who is this founder of Sun Microsystem? I knew. Yeah, his full name is. They don't even ask me to pronounce his full name, right? It's like Henberg, whatever. So this is a guy, and yeah, he started with Sun Microsystems, and then a lot of other companies, and then eventually got sued by SEC. We don't have to do that. Yeah. One side. Okay. All right. So let's get back to the stuff. Where was I? Yeah, so that was on Sam's side. I mean, there's a whole book. I listened through an audiobook on whole life of Sam, and yeah, bright guy for sure. You don't get into MIT just like that, but that doesn't some of the other emotions, those sins of life, 7 sins, no one has a control on that. Okay, did I miss any question? How to invest in money market fund? Is it possible through Merrill Lynch? Oh, I think yes. So ICSH is not a money market. It's a 3-month. It's a T-bill. So there are. You can look on your Merrill Lynch and search for I don't have my range plot fund, so I don't know what to tell you. But you can buy these money market funds on any of the brokerage platforms. Rajiv says Going Infinite. I think that is the book. Yeah, I don't have a physical book, but I borrowed it on audiobook on library. And then I was listening when I had to travel. I had like 4 hours of travel. So I used that to go through book. All right. So what did I buy and sell? And again, this is for transparency. I just want to share because we talked about a lot of stocks. I want to share what I did, in this week. So this week I just added a little more to Apple. Yeah. Nothing specific to look into this, no change, just that so much of negativity is priced into Apple. And it's still a big cash generation company. I mean, we talked about Apple. I still like amount of money that they generate. So added little more to it. And yeah, this is what my portfolio looks like at the end of March. So nothing much has changed from a Feb. SPY ETF is still the single largest holding in my portfolio. And then the cash is what, waiting to be deployed. And I like holding decent amount of cash because it helps me to sleep well and convert the crashes into opportunities, right? So a market crash, it could be an opportunity or it could be a disaster. Now, if you hold a decent amount of a cash, you can use it as an opportunity to buy stocks at a cheaper price. But if you are levered up, it becomes a disaster portfolio because then brokerage firm will sell the stocks that you you don't want to do that, right? So that's why I like to hold decent amount of a cash. Nothing much has changed. Mercado Libre still, number one individual stock, Apple, Meta, Microsoft, ACHD. And I've been adding to my ACHD position because this is like it's a dividend paying ETF. And I don't hold too many of our so-called dividend paying stocks in my, top portfolio. So I use this as a vehicle. QQQ, Tech, Google, ASML, IWM. I need to add a little more to IWM because if the Fed starts to cut rates, you're going to see small and medium, those companies, smaller size companies perform better than the larger size companies. Then Amazon, Berkshire, new entrant back is Nvidia, and Palantir dropped off just because, the shares moved up and down. Is Snow on the shopping list? Not yet. Not yet for me. I still find that the Snow is still expensive. Number two, as compared to, the story of Snow is now relegated to it's just a data warehouse company, right? So now, and then third is the charismatic CEO is out. Frank Slootman is out. We got Sridhar Ramaswamy as a new CEO. He's more of a product guy. He understands AI. That's what they promoted him to be CEO. But I want to see him deliver the results. He's never been in a sales position. What Snow needs is a lot of sales motion for their AI stuff. So I want to wait for Snowflake to perform and then see if I want to add it to my position or not. But right now, I don't even have a time. I don't want to add any more ticker unless I find it really, really interesting. So now, Snow is not on my list. Question: IWM is good or VTWO? The reason why I'll choose IWM is because the options are very liquid in IWM. Vanguards, if you're not doing, the easiest decision, the way to make a decision, look at that expense ratio, net expense ratio, or whichever is cheaper, pick that up. Unless you have other criteria. One criteria which I use is, guys, is it optionable or not? Is this options liquid enough or not? Because that helps me to reduce my cost basis. And so even if the VTWO may be cheaper, like less expense ratio than IWM, but generally the vanguards don't, the markets are not, option markets are not that liquid, then I won't put Vanguard, right? So let's say, yeah, pretty wide, right? 1 point bid ask spread is pretty wide, not for me. But if someone who's just buying and holding and doesn't have to do anything with the options, yeah, buy VTWO. See, I already have a position in IWM. Look at IWM, it's pretty tight market. So that's the reason. I will personally will choose IWM over VTWO because I have other consideration just beyond the expense ratio.
Yeah, that's interesting. But thing is, just curious question. How do you make money on this one? Like, how do you how options help you to reduce the price? That means you sell covered calls or something?
Yeah, there are a lot of ways, and that is where, and I know I talked about last week that maybe I'll redo the boot camp sessions. I haven't still figured out Wednesdays what time, or should we do it in this session itself? It's a long process. Yeah, I do covered calls. Let's talk about IWM, right? Let's look at my position in IWM. Now, I have a strangle on IWM, as you guys can see. So this strangle means I've sold a put. I've sold a put at 190, whatever strike price is. Let's say close to 200. It's, I think, at 198. And I sold a call at 215. What does that mean? That means if the stock goes below 198 by April expiration, I'll have to buy the stock at IWM at 198. And I told you, you know what? I do want to add IWM to my position. And I'll be okay to buy this at 198. But if IWM goes beyond 215, I will have to sell IWM. Right? So I did this trade when IWM was trading close to 205. So if a stock has gone from 205 to 215, I'll become a fourth seller at a higher price. I'm not losing, right? But if the stock goes down to 198, I'll become a buyer at a lower price, right? Buy low, sell high. And it forces me to follow the same, but buy low, sell high. So this is like one strategy I'm talking about, right? How to buy at a, and this is what when I do a boot camp, the first thing, how can you buy a stock at a lower price than what is in the market, at the price at which you are willing to buy it and get paid for it? And now, when I did this trade, I got paid $195. If the stock stays between 198 and 215, that $195 is for me. I mean, that I already got $195. So that $195 is kind of a dividend that I received from IWM without they paying me a dividend. That reduces my cost basis of holding my shares. Okay. I know I talked about a lot of things, but this is how I look at, if it is optionable, I can reduce the cost basis of holding the shares. Today, 60 to 70% of the stocks that I hold in my portfolio have a cost basis less than what I paid for them. There are few shares in my portfolio where the cost basis is zero. Because over years, I've sold so much of a premium on those that now I'm playing with the house money. So for me, my investment strategy, and look at Twitter, that's why I did my profile, is buy great companies, reduce cost basis, and sit tight. You don't have to do anything, or at least I don't have to do anything crazy. So that's why I look at if it is optionable or not.
Okay. But which, for example, that means you start again with buying 100 shares, for example, of one of the stock.
Not
Then you
yeah. So there is something called the wheel strategy. What do you use it instead of buying the share? Maybe I'll sell a put. Give me an issue. Let's say I don't have a snow, right? So let's talk about snow. Suddenly, let's say if I became bullish on snow and I want to buy the stock, I want to buy snow, and I'm looking at, okay, you know what? I think, and again, this is not an advice because I don't know what the snow is really worth right now. I have never looked, I have not analyzed and say I want to buy snow. But let's say if I were to buy snow and I'm thinking it's 161, I think it's too expensive, but I'll be willing to buy shares of snow, 100 shares of snow if it comes down to 150. Today, if I don't do options, what I'm going to do is go to my brokerage firm platform, put a limit order of 150, and then say this limit order, this is good till cancel, and I'll wait. If the stock goes to 150 or lower than that, I'll buy the shares. If a stock doesn't go over there, I don't get anything, right? Now, instead of that, what I would do, because now, I love doing options, I'll go and sell a put at 150. And no. Now selling a put on 150, what it allows me, it will force me to buy the stock at 150 if the stock stays below 150 on 17th May, which is anyway, I'm okay to do that. But let's say if a stock doesn't go below 150, I'm gonna make $405 right up front. In prior case where I have a limit order, I don't get paid. In this case, I actually get paid $405 up front. Means $4 per share I'm getting paid right now.
But that's right, Vijay. But what happened? But your opportunity cost is missed, right? For example, it came to 151 and you lost it. That means it's gone up like maybe 200, 250. But you didn't get a chance to enter, right?
Yeah, I mean, so you wouldn't have gotten a chance to enter if you'd done a limit order anyway.
Yeah, both cases. Yes, that's true.
Yeah, so I would rather do this because if the stock, I'm just right now just trying to, if you know right now that the stock is going to go 200, there are other ways and options to benefit. If you are sure that it's going to go 200, then I'll go and buy a call, which I generally don't do because it's all probability. I always work in a way in that I'm not sure what's the market going to do. Market will go against me. I try to invest in that way. So
Vivek, how did you get confident that 150 is the right price for this?
No, I'm not saying it is. I'm saying if you think that you're okay to pay 150.
But then how do you decide like 170 is too high, but 150 is I'm okay with it?
Okay, so then now we're talking about when I look at the stocks, how do I think that do I want to buy this or not, and at what price point, right?
Right.
But then there is a whole lot of different things that maybe we should. I've talked about it earlier also. Is how do you analyze a stock? So right now, someone asked me, "Am I interested in snow?" I told upfront, I'm not interested in snow, right? Because I don't, from a business perspective, I don't think I really like where they are currently. Let's say once I figure out that as a business, I like snow, what they're doing. I like, what their future prospects are. I like the CEO. Now then comes to the valuation of what do I want to pay for this? Now there are various ways to look at different valuations, right? You can look at a PE, you can look at price to sales, you can do a reverse DCF and say how much of growth is priced in. You can look at other comparative investment and say, whether should I invest in snow or should I invest in XYZ where I may have a better, chance of return. So those many things will go into picture. Right? Now, in case, let's look at snow. I've not looked at snow, but let's look at snow. I remember when snow came out as an IPO, it was trading at 80 times price to sales, 80. And many retail investors were crazy. and buying snow. I'm like, dude, doesn't make sense. If you look at the snow's S1, and I did a review in one of these sessions way back in 2021 when snow came out. And the valuation at around whatever $400, it assumed the amount of revenue that they're going to make was the total TAM that they mentioned in their S1, total addressable market, which they Snow put in their S1 document, is what was priced into the price of the stock. I'm like, dude, like, Snow cannot capture 100% of its market. It's ridiculous. So I'm not touching it. And again, now I'm looking at a Snow, 20 times the sales. Right? There's no way I'm going to give 20 times the sales to a software company, SaaS company right now. It's super expensive. 20 times the sales you could have gotten in 2021. Today, and I don't know what's up, but let's go. So there is you don't have to do all the research yourself. Let's go to Clouded Judgment. Jamin Ball, Altimeter Capital, he does a great research every week. He give you what's on SaaS, what's the general valuations looking at. What does he say? And where's the price to sales? And I didn't look at over here recently. Next 12 months revenue multiples. Yeah, let's look at the revenue multiples. To Snowflake, 14 times. What's the overall median is 6.4. 6.4, I thought it is maybe closer to 8, but 6.4 is the enterprise value of your sales is what market is willing to pay. I don't want to pay whatever 19 times. If I think the Snowflake can grow at 50%, maybe I'm willing to pay. But looking at my thinking around the business Snowflake, I'm not willing to pay 19 times. So I'm thinking it is super expensive. Maybe it'll come down to 140. Then I'll talk about it. So again, this is how you make it. It's not just looking at a chart. I'll tell you, I'll have to look into the number and see what I perceive about this company. And if you are not willing to do that exercise, guys, ETFs is the best thing.
Vivek, are there so here the price to sales ratio was 19, whatever, right? Are there is there an example of where it is in an acceptable range?
So even 19 could be an acceptable range if the business or my outlook around the business is bullish. I probably hold some shares. And again, I'm not talking about just P2S, right? I just picked it up for an example. In some case, I might be looking at price to earnings. If the company is a maturity phase, I look at price to earnings. If the company is in a growth phase, then they are not primed themselves for earnings, then I'll ignore the price to earnings. Then I look for price to sales, because right now the sales is what matter. Right? If the company is in a capital returning phase, then I may want to look at price to free cash flow. So there are different metrics that we may want to use at the different growth or different stage of a life cycle of a company. So that is not, I can't give you right now a single answer. And I've been learning it over years, and I still haven't figured out, what all metrics I want to look at. I'm also learning. But there was a question of how do I say that what price point I would want to buy Snowflake. If I like the business, then I'll come to the valuation. And then I'll pick up a valuation like instead of 19, maybe 10, 12. Does that means what the price I should pay for the sales? And then I'll determine, okay, this is a price point I'm willing to pay. Then I'll go and sell a put against it. Okay.
Thank you.
Yeah. And if I not willing to do this, yeah, I mean, this is a QQQ to buy ETF, and that is perfectly fine. I mean, for years, I just relied only on ETFs because neither I had a time nor I had a interest in looking into the individual companies. probably more, I didn't have a time. And now I decided I want to focus on this one. Now I have a time and I'll go and look at individual companies.
By the way, sorry, what did we look at in Clouded Judgments post? That 6.4 was what number?
That was a median next 12 months enterprise value. Enterprise value is market cap plus the amount of debt you have minus the cash. So overall, the value of your enterprise. So market cap is your shares multiplied by the share price, right? But then the company may structure its capital by having a lot of debt. Then that debt is not reflected in your in the market cap, right? So to know the overall value of the enterprise, that's why we look at enterprise value, which is market cap plus debt minus cash, because the debt what you got, that brings in the cash, right? So then you subtract the cash. So it basically nullifies the capital structure, the impact of the capital structure when you're looking at evaluation. If you only look at a market cap, then companies can play the game by leveraging a lot of a debt, which is what PE firms will do, right? When a PE firm buy any company, they load that company by taking a lot of a debt and hence enhancing the equity returns. But if you have a lot of debt, you can't service the debt. That's a straight path, that's a straight ticket to bankruptcy. So when you look at the enterprise value, that nullifies the impact of capital structure.
Okay.
Right. Do you use any of the IBD's analytical products like Leaderboard? No, I don't have access. I mean, I've not looked at that. If it is good, maybe I will try if you have a URL. So what I look at is, some of the ratios, etc., which I want to focus on. And again, I'm still open because I'm still trying to build what I want to look at, but I want to do something which I can stick over for a longer time. One quote which I read somewhere this week is,
Vivek, can you share this link?
it's a Clouded Judgment or Substack. So he does it every week. Jamin Ball. So I follow him on Twitter. He does it every week. He's a good follow if you are interested on the SaaS side. GuruFocus.com is good. Yeah, I had GuruFocus earlier, but there's too much of an info over there, and I didn't really make good use of that. Do you analyze 13F? Which site do you use? I analyze 13F just to know what the investors, big investors are doing. And you could actually get this 13F directly from SEC. GuruFocus has a section, what you used to call Guru Trades or something, where they'll put in what these funds are buying and selling. But I mean, I forgot which site did I use recently when I talked.
Whalewisdom.com. You use the whalewisdom.com.
Yeah, Whalewisdom. I mean, I just Google for it. I mean, because that's not my day-to-day work. I don't remember which site I Googled for it. And then it'll show me, okay, a few sites where I'll go and find, okay, which site gave me better information on 13F. But I don't analyze on day-to-day basis to see, should I buy because that big money manager had bought, right? Because I don't want to follow what the other money manager has done. You can get an idea from it, but then better do your own analysis. Don't go blindly. Last week I talked about the mistake, right? I did blindly what Berkshire Hathaway did. That didn't work out. So now I was trying to get rid of that shares.
So Vivek, my question was, I understand Berkshire Hathaway could make a mistake or some other fund manager, but there could be some collective insights, like let's say 10 funds or 20 funds are like buying a single stock. That's the thing which might come out of like a collective instead of looking at just filing by filing kind of a thing.
Yeah. So if everyone is bullish on that, that's already priced in.
Hmm.
So
Right.
Right. So then you're not going, you're not buying it at a cheaper price because then everyone is already priced in. So and you may be right, but here's at least my experiences. If I buy just because someone else has bought, or maybe 10 other funds manager have bought, I'll be the first one to jump the ship if the stock goes down because I had no idea why I bought that. But if I want to buy the shares, which I want to hold it for a longer term, that's where I found that unless I put in the work, I understand why I'm buying the shares. I don't build a conviction to hold the shares in the times when the times are tough. If it is a bull market, stock is going higher, go and pick any big follower and buy the shares. The real test comes in when the market goes against you. And at that point of a time, if you have not built your conviction, you don't know why exactly about it, will be the first one to jump out of the ship. And that may be the worst mistake to do. The better thing would be probably to add more to it. And that's my experience has been. And that is why I'll probably get a stock idea from someone, 39, whatever. Right? But then I have to build my own conviction. That only comes in if I have done the work on the stock. And there are cases where, I'll hold the stock because I don't think anything is wrong with their business, guys. Maybe some of these big fund managers have been selling. And sometimes, you'll come and see the folks coming and talking on CNBC about a stock. And on the other side, they'll be doing something else. On the Twitter, there was Gene Munster, right? Big Apple guy. Always come and talks about, how Apple is a great company. Then someone actually, I don't know which fund, I saw it on Twitter. Someone asked him around his Apple position. They said they sold off. When did you sell? And I don't recall it. He's been talking about Apple, and he himself sold off his position. And the latest one came from Gary Black of Tesla. Gary Black is a big bull on Tesla. If you're on Twitter, he's always like Tesla, Tesla, Tesla. Only 3% is his position in Tesla. So anyway, get a trade ideas, but you need to understand why you own the stock in your portfolio. And there will be a variety of reasons of owning a stock. Your reason of owning a stock could be very different from my reason of owning the stock, even though we hold the same stock. And I'll give an example, right? If we have a time. But that is why I at least have understood that I need to build my own conviction. All right. What else in the market? Let's go to complete.
Sorry, Vijay, actually the where you're shown the how to buy, right? Can you also help us as part of workshop how to maintain that to make to reduce the cost? Like that means every next month call you sell to make money for that.
Yeah, so let's park that for our detailed, that our option discussion, because I'll walk through during that. I'll walk through
We can
not
help.
just option. Maybe I'll include, let's say, stock, how to date a stock, how to get married, how to stay married, and finally, how to bad word, but how to divorce the stock, right? So what the things that we do while we are staying married with our stock, like reducing the cost basis, what we should watch out for, what not. We'll cover in that session because it'll take some time.
Sure.
All
Thank
right.
you. The right wording. Date, marriage and
I'm like, guys, if you want to buy it for life. At least for me, I'm not the one who'll buy and sell the stocks just because the stock has gone down few percent. In some cases, I will if the business has changed. If the business hasn't changed, then I don't care. Stock, I'll say, if it has become egregiously expensive, yes, I will sell. But if it is, 5%, 10%, 15% up and down, that's a price we pay to participate in the stock market. All right.
So, Vivek, have you decided when are you starting that Wednesday session? Sorry.
Definitely not this Wednesday.
Okay.
So probably the next one.
Sounds good. Thank you.
Yeah. So let me take about, some people told me that, hey, weekdays doesn't work, and a weekend, then I don't have any other. So other option which I was thinking is to maybe start this as 9:30 to 11 is when we do our, the in-depth option and the investing, and then 11 to 12 or 12:15 we do this regular session.
That's perfect.
Because
I like
some say, yeah, oh man, weekdays doesn't work. But then it means I need to talk for 3 hours, and I don't know how much you would want to listen to me for 3 hours. So that's another factor. I have not decided whether I'm going to do it on Wednesday or extend this one. Oh, we'll see.
We will listen. No hesitation from your side, because it's necessary for us to spend money, correct?
So yeah, anyway, whichever way, I will put it on the meetup. Sunday is the best, or no, Sunday is the only day when I actually get to meet some real people in real life, because investing is a very lonely business, right? Sunday is the way, Sunday morning I go out for a game with my friends. So that's my weekly activity. I don't want to do it on Sunday. Sorry, Henry. Well, that's my only day when I get to play, man. With my friends.
Saturday sounds perfect.
We'll see.
Oh, I'm sorry. Saturday. Yeah, Saturday is good.
Okay.
I don't know why I said that.
Okay.
Saturday's best. Saturday's best. Thanks.
All right. Anyway, so what else I'm seeing in the market? Like, reminds me of a Long Island blockchain. Any guys remember? If you were active in 2017, when the Bitcoin and the whole blockchain fever was going around, an iced tea company changed its name to Long Island blockchain. The stock was like up few 100%. Right? I'm seeing similar vibes in the market. A news came out saying Neelam Resources enters letters of whatever intent to acquire 24,800 block Bitcoin. Right? And this was tweeted by someone I follow, Watcher Guru, saying, hey, just in South American gold miner is buying so much of a Bitcoin. And I never heard of this company before. And this profile has 2.2 million followers, right? Why? Another reason why you should not follow blindly. Right? Person with a 2.2 million followers should be a little more, I would say, prudent in what they're posting. But nope, doesn't happen. So what I did immediately, I went to figure out which is this company, because I never heard about this company when it comes to blockchain or Bitcoin or crypto side. And I read this press release, right? Letter of intent with cyber data, then Mindwave, and then say the CEO is Pranjali More, and then say CEO is Pranjali. Here it says COO is this person. And that's where I started seeing red flags. Talking about fintech, Mr. Nathan of cyber data. I looked into this company. This is like an IT service company. And I'm like, what the heck? So to me, this press release was very fishy. And I look at market cap is like 900K. I'm like, so I just immediately tweeted a response saying, I don't think this company has the capital to even acquire Bitcoin. This is like clear pump and dumps stuff. Cyber data is in Mauritius. The press release has a different CEO. The website has a different CEO. So be careful. But that doesn't help, right? People just buy because, someone tweeted about it. They think it is authentic. You see, 2000%. Long Island blockchain. You add your name to the Bitcoin and the stock is up 2000% in a day. And then the next day, we see this. The CEO quits because it was just a plain pump and dump. CEO says, hey, this press release was done by a company. He didn't know about this, whatever. Who cares? And the stock just crashed. So do your own homework. 2.2 million followers doesn't mean that they really have done their homework. So don't go and buy the stock just because someone you follow, 13F, is doing it, right? Spend a little bit of a time to figure out, is it even possible? To me, it looks like, because I never heard of this company, to me, look like, what? And looking at the press release itself was so many red flags. I didn't have to go beyond the press release. And then day later, this came out, and now there's going to be FINRA, all that investigation and all that stuff. So, yeah, you got to put in some work. I mean, there is no two way about it. Otherwise, ETFs is the best way. Another craziness, DJT, annual revenue is 3 million, market cap is $9 billion. I don't know how it's going to end up. When will it end? And I really wanted to go short on this. Obviously, I don't want to short the stock because it's, the craziness can continue. So I thought maybe let me go in via the option way. So I started to look at an option. I don't know if anyone able to figure out what's the right way. Even if I do an option, even if I buy a put on this, it's like they are super expensive. So this is one stock wherein I don't think I can do anything about it, even though I know it is extremely overvalued, but it's not really worth to when I generally don't buy a put option, but in this case, I would want to buy a put option, but super expensive. Right? Me paying, let's say if I buy $25 put option, the stock has to go below, and say if I close it at $13, the stock has to go below $12 for me to make any money. And I'm paying $13 upfront to make $13. Not really worth. I couldn't figure out how to go short on this one. And it's yeah, and Jay says correctly, it's a cost to borrow is super high. It's a hard to borrow stock. Has anyone figured out what to do with this? I remember I had similar vibes during the Nikola day, and I was able to profit from Nikola. But DJT, I'm like, you know what? I'll just wait and watch it from the sidelines. I don't think.
The way I traded this a couple of years ago when it used to be DWAC is I sold call options, but I bought warrants, DWACW, as a upside as a hedge because the warrants were cheaper. And then I sold naked calls very, very, very far away from the money. So sometimes I made money both ways on that. So I'm not touching it today.
Yeah, I mean, now there are no warrants, and I don't want to obviously sell a call against this. I don't want to short the stock because we don't know how the craziness will stay. And the puts are so super expensive that I'm like, it's not even worth.
The other thing is this volatility, this IV will crush. Once it starts going down, the excitement will go away.
Yeah.
And the premium, so even if you're right that it will go down, you can buy a put and you'll still lose money because the IV will go down to 100 from 300, right? So yeah, it's hard to play.
Yeah. So similar stuff I've seen in GME, wherein I remember for a second, I bought a put, GME went down, I lost money because of the IV crush.
Yeah.
Yeah. So
I guess a bearish call spread would be an idea, and it caps your exposure, and then an IV crush will work in your favor, and the stock going down works in your favor. So
yeah,
either a call spread or a diagonal. You can sell the front and buy the back, but you'd have to play with it because the short-term call premiums are way overpriced.
And so if you're doing diagonal, how far out you go on the back end?
Well, here's what I do. Collapse the options chain for a second. So click on, so you can get to the product
Look at
depth.
200.
Go down to the last one, product depth,
Oh, there.
and open that. And then change that to theta. Instead of implied volatility, change it to theta. And here's how I see it. And now change it instead of show all, right here, change it to OTM. So you only see out of the money. Yep. Oh, sorry, let me delete that. And now you can see each expiration and how it decays. So for example, the 90 call, the closest one is the purple line right here.
Mhm.
You see that? So you could sell that and then buy something like that loses less theta, and like, for example, 90 and 95. And then you could model it on the analyzer. But this is quickly how I check how things decay and how much premium. Sometimes this line will go like this on the first expiration, and then I know I can safely sell here and maybe buy out there, you know. So
Oh, say some good pieces of wisdom. Thank you, Jay. Yeah, I've never looked into this.
Vivek,
yeah,
look
you
at
can see all the Greeks, so it's kind of cool.
Yeah.
You can see the volatility smile and how things are priced. If you see anomalies in price, it will show up there.
I have placed it trade that you can take a look at it and see if that makes any sense to you.
So
You're selling a straddle at 60 and buying a put protection at 30. You collect almost 30 points. So if at all by May, if it goes more than 90, then you would be at a loss. But if it is less than 90, you will be making some profit or the other.
So I copied this. Oh, there's a paste.
You can paste it. Yeah, there you go.
It's been such a long time I never used the paste, so I forgot where the paste was. So let's see.
Yeah, that's a wide profit range from 30 to 90.
Yeah, but then I have a naked exposure beyond 90.
I would not worry about it.
Oh no, I don't want to go naked on DJT. The craziness can, who knows that it will not be a GameStop. I don't know. I
Well,
don't want to.
if you're concerned about the upper side losses, you can change the put to the 90 call purchase,
Yeah.
and you would probably get the same amount.
Yeah, so
Then
maybe instead of doing, maybe we can do a iron fly.
Yeah, but you're going to collect a less amount of
True.
premium.
Yeah.
Okay.
So
That
so I
will work
definitely
out
don't
well.
want to go naked on the call side of this one. And I don't know how this craziness can continue. So I remember doing during the Nikola days, similar trade was an iron butterfly, which was like almost zero risk. The total premium that I collected was more than the width of the call spread or the put spread. It was a balanced one. And I was like, what the heck? How is this even possible? And then, if I asked a few other folks, and then we realized what the issue could be. At expiration, yeah, it was a riskless trade, but things could happen before expiration. If the stocks move too much, you'll get called away. And there are other stuff, the risk which wasn't apparent. I'm not saying the risk in this one, but it gives me those feelings. So maybe I'll try to do something over there.
There's always a way to do the trades. If you don't like this one, the risk, you can just sell the straddle, buy the 90 call and 115 vertical, 90 call and sell the 115 call vertical for January 26. and you're paying $2.73, and you'll be collecting a higher amount of premium.
So
But
sorry,
the downside risk is
sell the
unlimited.
straddle. So I sell the straddle. And then I'm saying go out and buy the January one.
Jan 26.
You buy Jan 26 wings.
90, 115 vertical.
Okay. Oh no, did I?
You want to uncheck the other one.
Oh, the other one.
There you go.
Why does it?
They have 95 call, but you can change it to 90, or you can leave it as 95 too.
Yeah, maybe I'll look into that one. But anyway, I mean, I don't have to get cued on this one. This demands too much of a brain cells.
I have not played this one, but those are the different things that you can look into.
Yeah. I mean, given that there are calls on the puts available, we can create, but there's no straightforward way which I can do it and forget about it. But yeah, thank you for sharing this one. We'll see. What else? Tupperware?
One quick question, guys. Actually, this is interesting. Whatever is the option picks, sorry to interrupt you one more second. But how do you pick this like option calls and the spreads, and which one is best, which one is not, and which expiry and which strike dates? Is there anything where we can learn? Is there any material where we can
Okay, I'm gonna point it out to the boot camp sessions. So if you can't wait for the new boot camp, just go and watch the boot camp recording where I covered what's the trade entry checklist and the exit checklist, how you pick up what strike price or delta you want to pick up, etc. So there are a few factors that get into that decision making.
Super, thank you. I will look for that.
So let me see which one was that. That was a moneyness. No. And again, that's not going to cover the scenario that we just talked about for DJT. Like the stuff in the DJT is what I've covered in this one, like trade opening checklist, etc., is because I was doing this along with my job, right? So I don't want to spend too much time in watching the screen. And so it doesn't need my full-time attention. So in the trade opening checklist, you will see what are the things that I used to think about before I open a trade, an option trade, right? Strike price, deltas, which ticker, that decision you have to take looking at what else you hold in a portfolio. So yeah, number 4 is what you should review. Okay, sure. Tupperware filed with SEC saying that they'll have to delay their 2023 filing. They did the same thing with 2022 because they are seeing ongoing material weakness in internal control and over financial reporting. This will be the reason if I hold Tupperware, I'll sell it immediately. Because this tells me that I can't believe the numbers that they are providing to us. So if I can't believe the numbers that are coming out from Tupperware, then there is no way for me to evaluate or, to have any way to analyze if the stock is even, worth holding or not, because I just can't believe the numbers. So if I'm holding this as just a lottery ticket, of which that will be the only reason. Right. So I was like, I'm like, 2021, Wall Street bet saved it because, it was behind every nostalgic brands, BlackBerry, Tupperware, and there are a few others that they went behind and tried to revive those old brands. But do you think now it's trading at dollar something is going to come back and maybe I want to buy the stock at this? wait for the, maybe there'll be some improvement. Stock is very cheap. So I looked at the numbers. I'm like, dude, I'm not touching this. Your revenue has been down 18%, profit is gross profit down, like, everything is red. So I'm like, no, I'm not doing this. So don't get emotional. It's I don't know who's gonna save them. Maybe Wall Street bets will come back, but for now, it's the story is done and dusted. Looks like nothing. I think I still have some Tupperware boxes in my kitchen, but I guess that my love for Tupperware. It's not gonna get my money though. So that's an interesting one. What else? Let's skip the GTC. It's been old news. Another news. CEO. Yeah. One more thing that you should watch out for. Again, CEO buying the stock is generally a great one. We'll come to that. But this one, Reddit CEO sold stock. Not just the CEO, but what I also read was some other leadership, folks in the leadership sold their stocks. So go, dump it on the retail investors. I don't think it even deserves to be at $49, to be very frank. If you remember what I talked about Reddit, I said this is a legalized version of highway robbery. And now some of that robbery is being played out in the market, where CEOs and other leadership folks have sold their market and dumped it on public. And that's why the stock came down from whatever, 70 to 49. I don't think it deserved to be at 49 also. But given the craziness in the market, the stocks could get pumped up anywhere. So if you have not done your homework, you don't know whether you should buy or whether you should sell. So I'm not touching Reddit at 49 either. Snowflake. There was a lot of chatter on Snowflake because the CEO bought $5 million worth of shares. And again, the fin to it was CEOs will buy the shares only for one reason. If a leadership buys the shares, they buy shares only for one reason, because share is going to go up. If a leadership sells the shares, that could be for a variety of reasons, not just because they expect the share to go down, because I want to live my life. I want to buy a new boat. I want to buy a new mansion. I need to liquidity. I'll sell my shares. There could be a variety of reasons. There'll be only one reason why they will buy a share, is that expect the share to go up. And that's where when CEO of Snowflake, Sridhar, bought shares, everyone was cheering Snowflake. Guys, spend some time. The CEO buying $5 million of shares was part of his employment agreement, right? So I'm like, generally, it's a bullish signature sign. In this case, it is not. His employment agreement mentioned he'll get additional RSUs contingent upon your purchase of shares at a fair market value of $5 million. And that's the reason why he bought $5 million worth of stock. So don't just start to go and chase Snowflake because CEO bought a shares. All that glitters is not always gold. So if you are not suddenly became bullish on Snowflake because CEO bought the shares, not yet. I'm not saying Snowflake is not a good company, but I'm saying this is not the right thesis for becoming bullish on Snowflake. It was a part of employment contract. He is just doing that. Nothing more to read in this. So couple of CEO moves I want to share, and suddenly, how people become suddenly bullish on Snowflake because CEO bought the shares. So, but that in this case, I'm still not bullish. I'm not for this reason, definitely. I'm not bullish for other reasons anyway.
Hey, like, isn't it a very usually employment contracts don't have something like this, right? Isn't this a bit of a tactic of sorts?
See, this could be because maybe we don't want to dilute the shareholders. I'm sure this is legal stuff, right? But if we'll give you RSU award, but we don't want to dilute the shareholders, maybe. I don't know what the reason is, right? But so if you look into the employment contract, and the beauty of these public companies is you can look into the employment contract of all the, what you call as officers of the company, right? These are available for you as an investor. So I immediately Googled Sridhar Ramaswamy employment contract. I could find it on SEC website. I'll look at how much is he being paid. He's being paid 750K as a base salary, plus 100% bonus, then plus some RSU award, additional RSU award. This is where I found that the condition of additional RSU award is that he has to buy $5 million of the stock from the open market. And then he has a performance awards, and then he has $75 million of stock option, whatnot. So I'm like, okay, that's the reason why he bought $5 million of these additional RSUs.
See, at 50 billion market cap, stocks worth 5 million that's kind of a drop in the ocean too.
Yeah, it's not a market moving stuff. It's more around a sentiment. And in the short term, markets just trade on sentiment. In the long term, it trade on fundamentals. In the short term, it trade on sentiment. Now, suddenly the sentiment changes. Gosh, CEO staked 5 million of his own personal worth into this stock. It means he's bullish that the company is going to do good and the stock is going to go higher. And then everyone start to chase the same stuff. And then in a short term, the stock goes higher. And that's yeah, I mean, it is what the market is. It is sentiment in the short term. On Reddit, won't there be locking period for CEOs? I've not looked into how they got around with this. Maybe there is some condition in which if they have already filed with SEC prior to whatever IPO, etc., they were willing to share. They are allowed to sell. I don't think these are the sales that they woke up in the morning and say, oh, I want to sell my Reddit shares. This were predetermined sale. And I've not got into the detail of this one. Maybe if we could have seen SEC earlier and see the filing, we would have known that it is coming up for sale. And again, I don't know. But I know for sure that they sold off. And that's why Reddit stocks fell down, because the CEO sold stock. Okay. All right. So this is what we already gone through. Well, let's go through a couple of shareholder letters. Larry Fink. And again, you can Google for this, but I'm not a shareholder of BlackRock, but I think this, I saw a lot of chatter around his annual letter, so I thought maybe I'll go through this. So I went through the letter. Here's the summary for you guys. So he started with talking about his parents, and he recently, lost his dad also. First, he lost his mom, then he lost his dad. Then he and his siblings were looking into their, what their parent had and their investment, whatever. So then he talked about that his dad and mom as a couple never made more than 150K, but the retirement account was sizable because they invested in stocks and bonds, capital market, right? There are two ways to grow money. One is to put money in the bank, which is what most of the Japanese savers will do. Other is put in the capital market. You give it to the companies so that companies can grow the business, and the companies grow, so you also grow, which is the US. The third one is like gold, where a lot of Indians in India, people will put money in gold. It is still there. I know things are changing, but then gold is proven to be a subpar investment for individual investors, because gold is mainly for your it's the unforeseen situations, really for bad situations, not really an investment vehicle. Then he talks about how Japan and India government are encouraging their citizens to actually invest, not put it in gold and not keep it in the bank. Okay. Then he talks about retirement systems. And I think his concerns around this retirement is what had a lot of folks talking about Larry Fink's letter. So retirement system have three pillars. You invest personally, like you and I, we do, or you have a pension plans which are provided by employers. Not anymore. And third is a government safety net, which is Social Security in US. So Social Security worked in the past because 50% of the folks never lived long enough to withdraw the money that they put in Social Security because our life expectancy wasn't that great. That's not the case anymore. So the risk that we talk about is something called a longevity risk. The risk that we have is that we're going to live for much longer than what the models of the past have predicted. And then we may not have enough of our corpus left. Social Security Administration say they will not be able to pay full benefits by 2034. I don't think that's going to happen because government will always go and fund, basically print more money, debase the currency, and still retain the same nominal value. And if you're eligible to withdraw $2,000, if you're eligible for a $2,000 of a Social Security payment, you will get $2,000 by 2034, but the worth of that $2,000 will be very less, because I don't think any political party will let Social Security not meet its commitment. Just that won't be worth. So how to fix the retirement dilemma? Work longer. He takes an example of, I think, was it Netherlands or maybe one of our Scandinavian countries, wherein they actually pegged their the retirement. I forgot. So they're basically raising the retirement age, and they pegged it to, I think, the life expectancy or something like that. So they say, yeah, you work longer. Yeah, as a society, we should create jobs for those who are above 65. Have them work longer and not move into retirement. That's one way to solve the problem. Not sure. I'm sure no one would like that. Or other is make investing more frictionless and almost automatic, so that those who have been during the workforce, those who have been in workforce during their lifetime, have enough investment corpus available. So he talks about 401ks and advancements that we have had in 401k plan over the years, and now by default he's basically proponent of the fact that by default 401k should be enabled, and it should be an opt-out system rather than being opt-in. Nearly 2 decades out. So other interesting thing, which I wasn't aware, saying 80% of the people, the nearly 2 decades after retirement, the average person still had 80% of the pre-retirement money saved. They didn't spend it. So first of all, we have a problem that people are not saving, but then those who are saving are not spending in retirement because it comes from uncertainty. We're not sure if I spend it now, will I have money left to meet my needs or not? And then he talks about how this uncertainty has come from switching from a defined benefit plan to a defined contribution plan. A defined benefit plan is your pension plan. Defined contribution plan is what is our 401k plan. And say that's why the folks are unwilling to spend even after 20 years into retirement, because they're still uncertain about future. There's no guarantee that they'll have a continued income. Of course, there are ways to create that guarantees, right? NVDs or dividend stocks, or whichever way. There are multiple ways, but not for a normal general person. And the biggest barrier to investing for retirement is fear. So fear and greed are the two, I would say, two traits that keep us away from investing anyway. Then he talks about infrastructure and energy. and how our future of the country is dependent on our investments in infrastructure and in energy. Talked about the infrastructure should be public-private partnership, not just depend on government, but private sector should also invest in. Today morning, I saw a news headline saying that the Baltimore Bridge, right, that thoughts for those who got impacted, there looks like there are 6 people who died. Horrible accident. But the worst part after that accident is now they think it will take 10 years for us to build back that bridge, which is crazy. China will build a bridge in a month. And it will take us like 10 years to build a bridge. What has we become as a country? I don't know. So, but that was a news headline. To rebuild that bridge is a 10-year project. We can't build a bridge? Gosh, looks like we lost the whole we don't know how to build things anymore. Many of the Asian countries will do it in much cheaper and much quicker way. But anyway, I don't know. We'll see. But that's a news that I just saw in the morning. And then he talks about energy decarbonization and energy security. So I was little. So as you guys know, BlackRock has been, behind the whole push of green energy, decarbonization in 2021, 2020, and they've been forcing their portfolio companies to, reduce the carbon footprint and all that stuff, ESG and all that thing. Now in 2023, they switched the tone. And I talked about it, they switched it because many of the Republican states banned them from managing their, and again, this is, you call it as a conspiracy theory, but many of the Republican states banned them from managing their, state pension funds. So now you have a real impact because BlackRock, you're talking bad-mouthing, let's say oil industry, you're bad-mouthing fossil fuel. Don't touch my pension fund because that's bad. You're bad-mouthing about coal industry, and my constituents are depending on these industries. I don't want you to touch and manage my pension funds. So 2023, we saw BlackRock started to backtrack a lot of its ESG initiatives. And so I wasn't surprised to see now he's talking about energy security, which in fact says, yeah, we want to decarbonize, but we also want to make sure that we do it in a pragmatic manner and have energy secured for us. If that means we have to do fossil fuel, that's fine and all that. Then he talks about, how they are also they hold a lot of fossil fuel companies, and they say it is because we want to focus on energy security as well. And then I think probably it was also because they wanted to bring up this Bitcoin ETF, which is like, in his own words, Larry Fink's own words, is the most successful ETF in the history of BlackRock. You can't do that if on one side you are saying, oh, Bitcoin is bad for energy, we need to have a green energy, and then bring in Bitcoin ETF. So obviously, at the end of the day, all these big money managers, it's all about money. So if you talked ESG because you think there's a money to be made, you get a kick in your balls and you get, you're not invited to the table to manage pension funds, you just change your narrative. And that's what we saw BlackRock doing. And then you want to make money out of a Bitcoin ETF, then don't talk about the fact that, the Bitcoin is consuming so much of energy and it's not good and all that stuff. No, you change your narrative, and that's what BlackRock did. And now it's like no one will support decarbonization if it means giving up their home in winter or cooling in the summer. So it's okay to use fossil fuel. Anyway, that's an interesting one. Debt. Then he talked about debt. And debt really matters and how the public debt has tripled since 1970s. And since the start of pandemic, US has issued roughly 11.1 trillion of new debt. And then he also talked about how the rolling of a debt has become more difficult. Till now, we could kept on rolling our debt as a country because the rest of the countries they wanted to continue hold US treasuries on their balance sheet. So we kept on issuing new US treasuries after one has matured, and then just kick the can down the road. Now, many of the central banks, and the reason why we see this whole bull run in gold over the last few months is a lot of central banks are now buying gold. So they are trying to diversify out from treasuries. So, and that's, you see huge bullish run in the gold. And gold hit a new, GL hit a new, 3 or 4 years high. Probably it's a new all-time high, maybe. And it is because a lot of central banks are now diversifying out of treasuries into other instruments. So if that is the case, then it will be difficult to roll the debt unless you start to increase the interest rates, and then our interest serving capability will be tested. I guess what now we are paying $1 trillion interest per year. If we have to reissue the debt at the current price, the current interest rates, it's not going to be easy. And the last one was a candid moment. He talked about he lost 100 million on a series of bad trades. And well, nobody needs to hear the story again. So even the best money managers have had their own patchy past. So if you lost money in a trade or a stock, don't worry. Everyone has done that. This is how the market teaches us to be a better investor. This is what I call as a tuition payment to the market. Bad trades, bad investment, bad exploration. So far as long as you learn from it, don't repeat it, that's fine. So that's on what Larry Fink had to say. And gold is at all-time high. All right, so last one is a Pershing Square Capital. Maybe we'll do it the next week. Yeah, it's longer than yeah. And thank you for someone, my friend with whom I went for a hike yesterday, reminded me that I talked about the podcast. I'll share the list, so maybe we'll do it next week. So I did prepare a list of all the podcasts that I listen to and why. We'll talk about next week. It's 12:25. Don't want to hold you for longer. Let's call it a day here. Remaining portion we'll cover next week. I'll be around for 5 more minutes before I head out for lunch. Any other questions? Can you share the pod?
Maybe I can ask you a question.
Sure.
People are more concerned about the drawdown or the concern of the market going down. And you did mention that the fear of the market going down is more than the actual drawdown or the market going down. With that in mind, do you suggest that we should be in the market all time and don't bother about the market going up and down? Or as some people say, you should step aside when the market is going down and reinvest when it goes sufficiently down. And if you do take a look at the markets, if you step out of the market for a shorter time period or whatever time period that you consider, or market timing, is that a good way of dealing with the markets? My idea is that we should always stay in the market. You can vary the amount of market investment and adjust based upon that rather than get out of the market completely.
So I am
you don't have to answer this now, but you can bring it up in your next meeting or whatever if you need some more time to do some research and come back with that.
No. So I think this is which I have looked at many studies around trying to time the market. And I think one of them I shared it in a few sessions earlier, wherein we picked up, there were 4 use cases. We picked up the unluckiest one, the luckiest one. I think it was from, I forgot the name of that person. Anyway, maybe I can bring it next week. But the gist and the summary of that was, if you're investing for a longer term, the delta between you buying at an all-time high and you timing it well to buying at the lowest is really not that great. It makes a difference if you're investing for next 2 years, 3 years. If I'm investing for 20 years, the difference is not enough. So I am of a firm believer that no one has been able to time the market. No one will be able to time the market. You get lucky sometimes. So I'm not going to even try to do this. Only thing I'll do is stay invested in the market, bring in the capital which I can bring in regularly in the market. Only thing, when I see the market or some of the stocks are all-time high, I'll manage the delta using options to tame down some of my portfolio stuff. If you're not doing options, then just keep doing a regular amount investing. And I'm a firm believer in that. And I've seen some studies on both sides. One side says, if you're trying to time the market, if you miss the 10 best days of the market, because you don't know when that's going to happen, market doesn't ring the bell and say, hey, today is going to be the best day, so bring in all your money. If you miss 10 best days of the market, then you severely underperform the market. Okay. So that is why I am not a favor of trying to time the market, even though we will see many folks on Twitter or YouTube saying, wait for the crash and you will be able to find the crash. I don't know. I've not seen even a single real money manager who says that they'll be able, or their teams have been able to time the market. So I'm like, then how can I? Warren Buffett hasn't been able to do. Howard Marks hasn't been able to do. Stanley Druckenmiller hasn't been able to do. Monish Pabrai hasn't been able to do. Bill Ackman hasn't been able to. So then why? I'm nobody. As a retail investors, we are nobody. So I don't even try that. Alrighty. What else? Yeah, so share the list of podcasts. So I did prepare a list. What I'm gonna do over this week, I'll just tweet out that list, and in next week meeting, we'll start our session with these 2 remaining sections: Pershing Square Capital shareholder letter. There are some good things over there, and then the podcast. But if you're following on Twitter, then you'll probably get to see that before the next session. Chandra, how do you manage your time for the investing and your work? Second question, also looks stress-free and cool. How do you do that? So, so I did with, and I shared earlier, for 8 years, I did along with my job. 2024, I've decided not to, at least not yet, to go back for a job. So that's why now you see me doing much deeper research. But it took me first 2-3 years where I have invested every free time in learning about the markets. So I gave up Facebook in 2016. I haven't gone back to that. I gave up Netflix for 2 years, no watching movie, and only focused on learning. If I'm dropping my kid in a gym, I'll sit there for 2 hours and read about the markets. So it took me 2-3 years of spending 2 hours, 3 hours every day after in evenings or in the night to learn about options and regular about markets and understanding market terminology and what does that mean. Yeah, I mean, we had to do that. You have to put in that hard work. And I look stress-free and cool. You have to put your portfolio accordingly, right? So any money that I need for the next 2-3 years is not in the market. And if you fix your personal finance side first, then your investment side can be worry free. Let me put it that way. Last question. Can you give us an overview how the risk is spread in your portfolio? I'm not sure what exactly you mean. Can you talk about it, Prabhu? What exactly you want to know?
Yeah. Hey, so I think there was some small cap and there was also some big companies, Google, Apple kind of companies that are going to be around for foreseeable future, right? So how have you divided it? Is certain percentage in ETFs, index funds, and certain percentage in direct stocks. Even within that, you've divided them into companies that are sort of empires at this point in time. And yeah.
Okay. Yeah. So maybe I'll bring it back. I think I do share in terms of how I build portfolio is core, which is gives a ballast to my portfolio. Then I have a growth. Then I have a rocket ships or like going to the moon, right? And do I have some stock which is like will go to the moon, but those will be very small percentage of the overall portfolio. So what I do is for me personally against each of the stock, I'll put a risk rating. And, this is a risk rating, and then I look at a pie chart. Okay, how much of a risk, how much of a portfolio is allocated to at a particular between risk rating or stuff. Or I look at a growth, moonshot, and a core, and how much of a percentage is allocated to that. So that's how I do it.
Got it. And what's as a general rule of thumb, how much is what percentage of your portfolio is for risky speculations sorts?
That
Is it two?
very, very small. One sec, let me just see if I have the chart.
Are you done?
Yeah, I'll be done whenever you guys are ready.
Done क्या बस
Almost done. Okay. All right, guys, I've been summoned. So I'll share it next week. We're going out for lunch. You heard my boss. All righty. We're going out. So yeah, I'll share. So I do have that way. I look at core, growth, and a rocket ship, and I can share what the percentage is by end of March. I had that chart somewhere. All righty. Bye-bye. Okay.
Thank you.
Okay. Yeah, we'll talk again next week.